I can't pronounce it. I love the guy. I loved him. I'm not embarrassed to say I loved him as a man, a person. He was an incredible person. He died of hepatitis what? C. And his treatment was horrible. His teeth were getting loose from the shit they gave him to try to kill this stupid thing, interfering. It was the treatment was more horrible than the disease. You think I'm kidding? Let's get back. He comes into the office, his gums are bleeding. I'm sitting behind him, I'm almost crying. He was a tough guy. And you know how we got it? He was Egyptian. And they had mass inoculations during the 1950s. And the morons, this is the third world country in Egypt, they kept on using the same what, Pamela? The same goddamn syringe! And they infected thousands and thousands and thousands of polio vaccine for children. And all these, 30 years later, all these children were inoculated. Thousands of them got what? Hepatitis C. Let's get back. You're real lucky that you live here. You're real lucky you live here. Let's get back. Okay. Yeah, life is a bitch. Okay. So now, you're so fortunate to be here. Let's get back. Don't ever forget that. And I'm not waving the American flag. I hate the government. All right. But it's true. The quality of our life is like nowhere else in the world. And the Shah of Iran, when he had cancer, where did he come? Here. David Rockefeller and Henry Kissinger opened the way for the Shah of Iran to come here and be treated at Sloan Kettering for his cancer. He died anyway. And then the result of that was Khomeini and the problems that we've had with Iran ever since. Okay, so it was consequences to that. Let's get back. All right. So now, the world's a complicated place. All right. You don't even know who the hell David Rockefeller is. He's dead. You should know who he is. All right. So now, here we are. Number 3. Same thing. Vicky gets 12,300 gross income. Olaf, it looks like he's allowed to deduct as an itemized expense and Schedule A interest expense. Step 1. That's step 1 to the lender, step 1 to the borrower. Step 2, same analysis. Then Vicky made a what? A gift of how much to Olaf? 12,300. Now Olaf has the 12,300 to be able to impute back to the lender. It doesn't impact on Olaf because it was a gift. He's the recipient of a gift. Includes it in the formula, income broadly conceived, and what, Pamela? The recipient of the gift excludes it. Wash transaction, never hits gross income of the recipient. And we are what, Muhammad? Done. Hallelujah, thank God. Okay, let's move forward. There's a problem. I don't know, this goddamn machine, either I'm in the early stages of Alzheimer's, which is quite possible, or else I ran this through the machine. I must have pissed somebody off, some spirit somewhere, and all they're doing is toying with me every day. And I suffer the consequences of it. Because it didn't print. So now we're going to give you the, write, God forbid you should have to write. I thought it was in the packet I was giving you this evening. Maybe it is, but I looked through some of them and it was missing. So I don't know what the hell happened, Pamela. Because when I ran through the first copy, as the pro forma, it printed. And then I walked away and I ran 80. And then I come back, and I only have time to do it once. All right, let's get back. So here we are. Jane loans $80,000 to her son. Jane loans $80,000 to John, her son. So let's diagram it, Muhammad. I'm anal retentive. We got Jane, and Jane is the what, Muhammad? The lender. She also happens to be mom. It's a related party transaction. Mother, mom. Okay. Then we got John, and John is the what? The borrower. And he also coincidentally happens to be her what? Son. Because we wouldn't be lending interest-free to a stranger, would we, Muhammad? Probably not. All right. So we have a loan, and the principal, the corpus of the loan, is how much from our facts? Originally, $80,000. We're going to change it, Muhammad, or the problem changes it. The loan, principal, is secured by, oh, interesting. The loan principal, this is from the other book, so they're more detailed. the loan principal is secured by John's residence. So what did John use the proceeds of the loan for, Muhammad? To purchase a primary residence. And then he used that residence as the collateral for his mom to grant him the loan. So then it looks like that the home, the house that he bought, is a qualified residence. So then we have, in all likelihood, QMI, qualified mortgage interest, which means that John would be able to, if we impute interest back to the mom and she has gross income, then we have Liz Taylor symmetry in the code, and in all likelihood, John will be able, as an itemized deduction, deduct the interest expense. We have Liz Taylor symmetry in the code. Okie dokie? Got it. Okay. But the agreement does not specify any interest. So mommy doesn't want to make any money off her beloved son. 0%. John's net investment income under the original facts. Important, Muhammad. John's, do you read my writing? Let me start it again. I'm brain dead. John's, indication of how tired I am. John's net investment, I'm abbreviating, income is $800. Muhammad, you already know how to do this, my friend. Where are we? Go through the analysis very quickly, Muhammad, with that superior intellect of yours, please. Louder.
The exception 1.5 because it's more than 10,000. So we're on the
Very sexy. Continue, Muhammad.
So we're on the exception 2, which is 10.
Loans between individuals of 100,000 or less.
And then
We have the overall limitation of what, Muhammad? Net investment income, $800. And then we have the de minimis rule under exception 2, that if the net investment income is less than $1,000, then what do we do, Muhammad? Nothing. Nothing. So first question is Pamela. First question is, how much interest under these facts? How much interest is imputed on the loan each year? Muhammad, what's the answer?
0.
Very sexy, very sexy.
Excuse me, Professor, you did give us copy.
Oh, it's there, it's on the other side? Beautiful. So great. Look on. Thank you, dear. Wait, did everybody get it or just some? I think at some point it stopped.
The last part of
you give us enough.
Oh, yeah, thank you, dear. See, there are spirits up there that are toying with me, but then there are other spirits that are helping, so I guess it's good. All right. Assume that the amount of, now we're changing the facts, Muhammad. The loan is how much? 125, if you got it. 125, you don't have it, I'm putting it up on the board. Now B says, assume that the amount of the loan is now changed, not 80, 125,000. How much interest is imputed on the loan? How much interest is imputed on the loan? The rest of the facts are what, Muhammad? The same. So now what do we do, Muhammad? What do we do? Very sexy. Compute the imputed. Why? Wish I could spell. Why? Why do we compute the imputed? Because the corpus of the loan is what? Greater than, between individuals, greater than what? $100,000. Now, does John's net investment income now apply? Does John's net investment income of $800 now apply? Exactly right. Very sexy. That only applies when we're under loans of $100,000 or less between individuals. Under exception number 2. This don't apply now. We're not limited. We don't have an overall limitation of net investment income. That doesn't apply. So now what do we do, Muhammad? And they tell us that the AFR, we need this, is 8%. So now what do? We take the what, Muhammad? The corpus, C-O-R-P-U-S, or principal, I'm abbreviating, P-R-I-N, C-I-P-A-L, P-R-I-N, the principal, 2 names for the same thing, 125. We take the AFR, we do what, Muhammad? Divide by 2, we're using what, my friend? 4%. Times 4%. Let's see, that's what? That's 4,000, that 5,000, Muhammad? Yes? Check it with the calculator, I'm tired. Yes? Beautiful. Then what do we do, Muhammad? We add it what? Back the 125. 6 months later, we would technically go back to the cumulative bulletin, see what the short-term rate is. This is the demand gift loan. Hold on. So now it's what, Muhammad? 130. 130. I'm being facetious. 4%. That's how much? 5,200. Yes, Muhammad? Yes. And then we add this, Muhammad, to this, don't we? And our total is 10,200. Yes, Muhammad? Okie dokie. So now what do we do, Muhammad, under these facts? One more time. B says, for those of you who don't have or didn't bring the sheet from last time, it says assume that the loan is 125. How much interest is imputed on the loan? How much interest is imputed back under 7872 to Jane, the lender? 10,200. She has what, Muhammad? Of 10,000 what? She picks up on her own personal return. Why? We're mitigating what? Income shifting. Income shifting, the whole point of this code section. Now, under these facts, John, if he bought a primary residence and he used the underlying residence as the collateral to be granted the loan, then he probably has on Schedule A, which is an itemized deduction. He has an itemized deduction, we haven't done it yet, of how much? QMI, it's qualified residence, then he has qualified mortgage interest. Now on Schedule A, he'd be able to deduct how much, Muhammad? We have symmetry in the code. Most of the time, we have rare exceptions, Muhammad, where we do not have symmetry, but I'll bring that to your attention as we go through the course. Most of the time, we have symmetry. Liz Taylor, that's why we did it. Okay, now lastly, and this really is not too important, Pamela, and it says, is John allowed to deduct the imputed interest? And the answer, Muhammad, is yes. And then finally, D, what other tax implications are there for this loan? Well, here's where they're going with it, Muhammad. Remember, step 2 to the lender has made a what? Gift. The lender, Mom, Jane, is the what? Giftor. Transferor. Pamela, same thing. Donor. Transferor. Donor. Giftor. However you want to call it, pretty much the same thing. John is the what? The giftee, the recipient of the gift. So the giftor, here's where they're going with this. Not income tax consequences. We just did the income tax consequences, Code Section 7872. They're talking about what other implications could it have, and they're going where the gift tax is assessed on who, Muhammad? There, usually when there's a gift, there could be, Pamela, gift tax, G-I-F-T, tax consequences. But under current law, for 2011, 2012, you're allowed to gift per person per year $13,000. $13,000 per person per year. That has no what? It's excluded. Has no gift tax consequences to the giftor. So how much was this? How much was the gift? 10,200, which is less than what? The 13,000. Now that's per person per year. So if, changing the facts, if Jane has 13 grandchildren, no, make it simple so I can do the math because I'm brain dead. 10 grandchildren. 10 grandchildren. Jane is a what? Calendar year cash basis taxpayer. So January 1st to December 31st. December 31st, we're coming to the end, Pamela, for what? Tax year. So now, how much for 2011 can she give per person per year? Tax-free. She's allowed to not have to use what's called her Pamela. Now we're getting more involved. Don't worry about it. It's called the unified credit. We're not using the unified credit. She's allowed to give per person per year $13,000. Now, Muhammad, remember the purpose of women is to make men miserable, so her husband was in an early grave. But if she was still married filing jointly, then we would do what, Muhammad? So how much would it be per person per year? Married filing jointly. Married filing jointly, how much per person per year, Pamela? Twice, 26,000. But she drove him to an early grave, so she didn't remarry. So now she can gift 13,000 per person per year. She has 10 grandchildren. On December 31st, she can make them a gift of 13,000 per grandchild. So how much has she removed from her taxable estate? Times what? She removed how much, Pamela? Then the next day is what, Pamela? January 1st. It's a new what, dear? So then the next day, January 1st, she can take out the old checkbook and she can do what again, Muhammad? 13,000 per person per what? How much, Pamela? How much in 2 days, December 31st, January 1st, can she exclude from a gross estate? That's a very simple planning opportunity. But that's where they're going with this one. That's graduate school, state and gift tax. You'll get into all this. Not now, not now, not now. And for your edification, we have a executive MBA program in what, Pamela? Taxation. But frankly, to be honest with you, the employers like you to be diversified. They want you to have a diversified education, so they frown upon you going to the same school for your graduate degree that you got your undergraduate degree. Because it's the same stupid professors, same stupid students. They want you to have them more diverse, so you go to another Y. If you have an interest in getting an MS in tax, or go to law school and then get specialized in tax afterwards, you don't get whatever your area of emphasis is going to be in graduate school, you don't go to the same school that you got your undergraduate degree from. But we do have an executive MBA program in taxation here. It's a pretty good program. But also so does Fordham, and so does PACE. So you'll look into, if you're going to stay local, there are much better schools than these three, but all three of the ones I mentioned are good, very good schools. Okay, let's get back. That's graduate school. And we're what, Muhammad? We're done. We've got to leave this. We've got to move forward. We beat this to death. Let's move forward. Now I'm looking at, I gave you some handouts tonight. Now we're looking at what, Muhammad? Annuities. Anybody not